All right, guys, welcome back for another video. Well, in today's video, I want to do an update to the Bitcoin Trading Journal series and also talk about the Federal Open Market Committee, the FOMC meeting targeted for tomorrow, or scheduled for tomorrow, November 2nd. I've got the previous FOMC meeting from September marked off on the chart, and also the one for tomorrow marked off as well, these blue vertical lines right here. Now, this is significant because I actually took this long position, this 340 Bitcoin position, from the previous FOMC meeting in September. And I've laid out, in previous videos, my rationale for why that would be a base in the market. So I think it's very fitting to do this update, prior to the FOMC meeting tomorrow. Now, I'll do a little bit of an update on this position in particular. I've got this 340 Coinbase long position, long position in Bitcoin, 340 Bitcoin long on Coinbase from roughly 18,444. Now, it looks like I entered the position here, but I actually entered during the September FOMC meeting. And, you hedge a little bit, take profit, and add a little bit of risk over time. And your cost basis does generally tend to creep up. So that's what you're seeing here, just a little bit. And I also have this short position on Bitstamp, just hedging my exposure. You can see here it's basically, from the middle of this consolidation right here, actually in profit right now. So, if it's always good to have a hedge in case, price just collapses towards your entry. You've got that hedge. It's just, an optimal way to be doing things. And also, you've got this account history here. You can see recent trades. Now let's get back into the charts. All right, let's go back to Coinbase real quick. We've got these. I really want to focus on these vertical axes, kind of denoting the FOMC meeting, because I do think they're very significant. Typically you see the Federal Reserve. The FOMC meeting is generally serving as a bottom in the market, at least temporarily, even in a period of a significant downtrend. And the reason for that is because, the Fed will generally come out and do exactly what they say they're going to do. And any of the uncertainty and risk in the market around the Fed coming out and overdoing things is suddenly taken out of the market, and the market generally rallies. Now, I think the most likely scenario for tomorrow is that the Fed comes out and raises 75 basis points. That's what they've said they're going to do. That's what they've told the media, and they generally like to do that. They don't like to come out and create any surprises. Now, certain people who have historically been leaked information to the media on behalf of the Fed, certain reporters for the Wall Street Journal who will not be named, they have indicated that the Fed is actually going to use the FOMC meeting tomorrow as a stage to create a scenario where they can lower the expected rate of future interest rate rises. So not necessarily lower interest rate objectively, but lower the future raises of interest rates, if that makes sense. So lower the rate of change. And that's important because that is lowering the rate of change below the expectation that is currently priced into the market. So, if the market expects the Fed to be as hawkish as they have been for the last few FOMC meetings and continue to increase interest rate rises, even increase the rate of change, at the very least, continue to do 75 basis point rises, that's part of the expectation that exists in the market. So if the Fed comes out tomorrow and raises 75 basis points, what you want to pay attention to is what they say about what they're going to do at the next FOMC meeting in December. And if they say, we're going to slow the rate of interest rate hikes at that meeting, that would be, set the stage for a relief rally in stocks, risk assets. Now, it's still, even if you're raising interest rates at a lower rate of change, it's still relatively bearish to be doing that, to be raising interest rates. So it's really just a short-term volatility predictor. You could have a scenario where you simply lays the case for a bear market rally. And anybody who's traded bear markets, that bear market rallies can be, extremely, extremely violent. Uh, you know, Even more so than a bull market rally. for whatever reason, right? Well, generally you have more shorts covering in that scenario, and that kind of adds rocket fuel to it. But again, we don't know. We don't know what's going to happen for sure. So we can only react to what does happen at tomorrow's meeting. So we've got the previous one marked off. We've got this high marked off. Now, we took this high out, came down based off it, and we're kind of, hovering around that region. Now, typically what you see, I mean, this is very characteristic of price, prior to an FOMC meeting. You'll see volatility contract generally going into that data event. What's happening here is liquidity is drawing away from the market. So whenever you see this volatility contraction, it's setting the stage for volatility expansion, right? Because liquidity is drawing further away, right? This is not a scenario in the market where you want to have resting limit orders on nearby price, right? Because volatility is probably going to expand and expand very dramatically following the data release. One way to describe that is that when the data hits the market, the central bank or the Fed, in this case, will open the door on price and liquidity, and the market will expand to reach it. So with that in mind, if I'm going to my this hedge position, I want to be able to capture that, because what you might see, tomorrow is you might see an expansion of volatility where price runs above these highs right here and then runs below these lows right here, and then closes the day back right where it started, or runs below and runs above and closes back where it started. It does the sequence doesn't matter, but the concept is basically that a lot of times that's what happens around these data events. Price will expand, grab liquidity. That's what we saw at the previous FOMC meeting. If we go back here, so here's actually where the Fed, Jerome Powell, started talking right here. I remember because I traded that day, actually took this position. And he started talking, price ran above these highs right there, ran below these lows right there, volume came in, and by the end of the day, price closed basically right back where it started. It's very characteristic of FOMC trading days to do this, and also to serve as a temporary bottom, right? To do this type of whipsaw behavior, bottom out, serve as a base for, at the very least, a temporary rally. So you get this, you get that type of formation going right there. And, what do we see on the weekly? Well, we actually have confirmed weekly bullish divergence, the first time weekly bullish divergence has ever been confirmed in Bitcoin's history. It's really quite amazing, actually, to be able to say that. And, it is really wild. We've got this close. People trade very differently, right? Some people would trade this. Some people would say the RSI divergence is confirmed as soon as you start closing above prior weekly high. Actually, that is the way I would do that as well. So when I was trading this, I saw the FOMC break above this high right here. Remember, we talked about this break. So this actually happened during FOMC. So you got this candle right here, and then during FOMC, price closed or traded above it right there. Actually, it may have been a different week, but anyway, the concept is basically the same, right? As soon as you saw that, that's when I was looking at this as confirmed. But other people, they'd be looking for a close above. Well, we got that close above last week on decent volume. So, if you're looking at that, if you are trading the RSI, same thing with 3-day. You got this multi-series of divergence. We mark it off like this. Something like this. And stochastics are crossing up, curling up. So, we see a similar type of read on, of course, you don't have stochastics crossing up on the daily, but you still see in general, the same pattern on the RSI. Got the same pattern going right there. Right, you got these multiple drives. If we move this right here. Well, not quite right there. You just got this. Well, actually, let's see. You got this drive. This drive here, just barely higher low, lower low on price, another higher low on RSI, lower low on price. Remember, that's our FOMC bottom right there. That is the bottom in the market. That's where I entered this long position. We got another test down below there, right here. What makes this really interesting is, this is a clear stop run, right? You got so the low on this candle right here is 18,153 on Coinbase. The low on this candle right here is 18,131. So just roughly $20 below this low right here. Price runs just $20 below. And look at this huge wick close back within the range. Anytime you see that, it's a massive stop run. But I'm sure it tagged a lot of people, it's always, the market is always going to whip around at a major level to, grab liquidity before the ultimate move up above, the range highs, if that's how the market is going to play out. Now, what we can mark off here is if you're looking for a swing failure pattern, right? If you're looking for this to break down, there's very clear breakdown right here, right? So, you can mark off this low right here, put an X right there, right? If now during FOMC tomorrow, price may run down and grab liquidity below these stops right here because people will have stop loss orders below these lows. And going back to that volatility concept, uh, I I don't know how much I would pay attention to that in this scenario, but if we do see price start closing below this level, then that's going to start looking more and more like a swing failure pattern. And if I did see, a 4-hour close, say below this level right here on Coinbase, that's when I start, start looking for price to run lower, right? If I were to see a 4-hour close below these lows right here, anytime tomorrow, really anytime at all, really, then I would be looking for price to run liquidity to the downside, not necessarily the floor to drop out in the market, right? I think the market has already capitulated, right? The floor is not going to drop out, and of course it always can, but post capitulation, what I think you're more likely to see if price does break structure to the downside is for price to go run liquidity to the downside in another, you know, engineered liquidity run to the downside, right? So, and whether it's this low here or this low here, or even this area here that gets ran, or even this area here, or even the uh, June capitulation lows. Uh, Again, it's not very clear how far price will run for liquidity, but that is the basic framework that I would be using to understand what price action is doing if it does close below that level. So it's a very clear switch in my mind to start managing risk, right? And that's very important. Right now, of course, I do already have this hedge going on Bitstamp, so I'm not going to close this anytime soon. I do have this buy limit order right there just in case FOMC. It's like a take profit on the hedge, right? So if FOMC runs down and grabs that, then I take advantage of the liquidity. But if price closes below this level, then of course this hedge is going to stay on, and then I would start adding to this hedge on retracements after that 4-hour closure. So I think it's always helpful to entertain you know, to entertain the scenario where your trade doesn't play out, right? And that's part of the reason why hedging is a very effective tool, because not only is it modifying your chances of success statistically in a good direction, but it's also opening you up psychologically for the realities that exist in the market, right? Even if they're not the most likely scenario, right? There's still possibilities that exist, and just opening up a hedge um, against those possibilities is basically casting a vote in the direction of reality, right? In the sense that low probability scenarios can play out, right? And when you open a hedge, you're acknowledging that basic reality that exists in the market, and it just opens you up psychologically to be better able to identify what is happening currently. But anyway, tomorrow will definitely be a day to pull out the popcorn and see what happens, because we probably do see some fireworks, right? We've seen some volatility contraction going into this data release. I do expect that if you are following price action tomorrow, that it will definitely be some type of event, and we probably see a good deal of price volatility. So I'll leave it there. I hope you guys like this video. If you haven't subscribed already, please just make sure to subscribe, and I'll catch you guys in the next